Hey everyone, and welcome. Today we are tearing into a really detailed analysis of one of North America's banking giants, the Toronto Dominion Bank, better known as TD. Everything we're covering today comes straight from a fantastic deep dive by Save Invest Compound. So let's see if this is a hidden gem.
So let's just get right to it. The big, audacious question that frames this entire breakdown is this: could TD Bank actually be a 300% investment over the next 16 years? It's a huge goal, right? And we're going to use that ambitious target as our guide for everything we look at today.
So here's our roadmap. We're going to start with the basics, what TD actually does. Then we'll dig into what gives it a competitive edge. From there, it's all about the numbers, the risks, and figuring out that all-important question: what's the right price to buy? And then, of course, the final verdict. Okay, first things first. What exactly is TD Bank? Because before you could even think about investing, you've got to understand the business from the ground up.
TD's business model is honestly refreshingly simple. They're a huge retail bank. Their bread and butter is taking in deposits and lending that money out. Super stable, super conservative. But here's the secret sauce. They have a massive presence in both Canada and the US. That gives them this awesome mix of Canadian banking stability with the huge growth potential of the American market. And remember that big 300% question from the start? Well, here's the math behind it. The specific goal is to see if TD can deliver an average return of at least 9% a year every year for 16 years. This right here, this is our North Star. Every single thing we look at from now on has to pass the test. Does this help us get to that 9% annual return? So any good long-term investment needs a moat, right? Something that protects it from the competition. So what's TD's durable advantage? What's going to keep its profits safe for years to come? Well, it turns out TD's moat is pretty wide and deep. First, its sheer size gives it access to cheap money through all those deposits. Then you've got the fact that it's a huge pain to switch banks. I mean, who actually enjoys doing that? Nobody. Throw in a powerful brand name, those growth opportunities down in the US, and the fact that it's incredibly hard for new competitors to even enter the banking space, and you've got a real fortress. But here's a really important reality check from the analysis. The fortress is strong, yeah, but it's not really getting any bigger. TD's moat is stable, it's deep, but it's not expanding. That tells us we're looking at a solid, defensive business, not some crazy growth machine. All right, enough theory. We get the business, we get the moat. Now let's get our hands dirty and dive into the numbers to see what they say about TD's real value. Now, before I show you the numbers, we need to be on the same page about a key concept: intrinsic value. Just think of it as what a company is actually worth based on its ability to make money over its lifetime. It's totally separate from the stock price, which can bounce around based on fear or greed in the market. Okay, check this out. The analysis pegs TD's true value somewhere between 155 and 165 Canadian dollars. But when this was written, the stock was trading at just 136.50. That's a pretty clear sign that it might be undervalued. And look at that PEG ratio down there, 0.82. Anything under 1 is generally considered attractive because it factors in not just price, but also growth and dividend yield. It's a very positive sign. And this number right here, wow, a return on equity of nearly 18%. In simple terms, this means TD's management is incredibly good at taking shareholders' money and turning it into more money. It's a huge sign of a high-quality, efficient business. So you're probably asking, if it's so great, why is it on sale? And that's a great question. The analysis argues it's a classic case of the market getting spooked by short-term problems, specifically some regulatory stuff in the US. The big idea here is that these are just temporary headaches, not a fatal flaw, which creates a window of opportunity for long-term investors. Of course, there's no such thing as a risk-free investment. So now we need to look at the other side of the coin. What are the potential headwinds and tailwinds that could affect TD? Now, this isn't your average run-of-the-mill SWOT analysis. This one is weighted, which means it gives more importance to the most critical factors, like strengths. And you can see the strength score a huge 8.5. When you add it all up, TD gets a final weighted score of 7.36 out of 10. That's a really strong report card. So the analysis also maps out 3 possible futures. The most likely scenario, the base case, puts the value right where we thought it would be, at $155. But even if things go wrong, the bear case still values it at $120. And if everything goes right, the bull case sees it hitting $180.
This gives us a really logical range of what to expect. Okay, so this all leads us to the most practical, actionable question of all. If we want to hit our goal, what is the right price to actually buy the stock? This chart is pure gold. It lays out the math perfectly. See that line there? If you want to hit our target of a 9% annual return over 16 years, the analysis says you need to buy in at around 135 Canadian dollars. If you want a 10% return, you need to be even more disciplined and wait for 125. This lets you make a decision based on data, not just gut feeling. And check this out. Here's another layer. This shows how your own timeline changes the price you can pay for that same 9% return. The longer you plan to hold, like our 16-year goal, the lower your entry price needs to be. It's all about giving the magic of compounding more time to work. Okay, we've gone through the business, the moat, the financials, and the price. It's time to put all the pieces together and land this plane. What's the final verdict? The analysis gives TD a risk score of 6.5 out of 10. Now, that doesn't mean you should run for the hills. It just means there's a moderate, understandable level of risk here, which accounts for things like the economy and those regulatory issues we talked about. But look at the other side. The opportunity score is a really attractive 7.8 out of 10. So what this tells us is that the potential reward seems to strongly outweigh the moderate risk, especially at the right price. That's a fantastic setup. And here it is, the bottom line, the final takeaway from this entire deep analysis. The verdict is to buy, but to do it with discipline. The stock is considered attractive anywhere below 140 Canadian dollars. That gives you a nice margin of safety and a clear path toward hitting that long-term goal. So let's wrap this all up. According to this Save, Invest, Compound analysis, we have a high-quality bank with a strong, stable business. It seems to be trading below its real value because the market is focused on short-term noise. And the numbers show that buying with discipline below that $140 mark could set an investor up to achieve that 9% annual return target. It's a really compelling story for a long-term investor. Now, I'd love to know what you think, and more importantly, what stocks should we break down in our next explainer? Let us know in the comments. Thanks for tuning in.